Today's interview is with Matt Engel. Matt started in the single family space. He did a little bit different. They did some lease with option to purchase, and they actually put it in an LLC. So he talks about how he did that. That was interesting. And then he went on to invest passively in a syndication, and then he went on to do his own syndication. So he talks about why he did that, and why he likes investing in syndications. If you're watching on YouTube, don't forget to like and subscribe. And if you really enjoy the interview on podcast, please give me a 5-star review on iTunes. And yeah, if you want to write a review as well, that would be even better. It's also available on Spotify and Podbean, and then also wrestlingwithrealestate.com. Enjoy the show. Hello and welcome to Wrestling with Real Estate, where we look to chokeslam all your real estate problems. I'm your host, former WWE wrestler and now Cirque du Soleil performer, and of course, multifamily real estate investor, Barri Griffiths. Now today we're joined by Matt Engle. How are you doing today, Matt?
Great, Barry. How you doing?
I'm doing fantastic, I'm a little sweaty here in Las Vegas. I think we're 111 today, so I'm trying to stay out the heat, but it's not a bad problem to have. I'm from Wales originally, so any day the sun is shining, I'm happy.
That's right.
How's it in Columbus? How's the weather in Columbus today?
It's actually pretty cool today. We've had a lot of 90-degree days the last couple of weeks, but today it's only in the 70s. So.
Okay. That doesn't sound too bad to me at all. So do you want to give us a brief history into your background and kind of what you're up to right now?
Sure. My name is Matt Engle, and I started investing in real estate in 2015, mostly to help other people enhance the quality of their lives. And so we created, first, we started with single family rentals to raise funds for, I guess not raise funds, to help make more money for myself so I can support and fund projects that are helping improve the lives of other people. And then I used to be a nuclear engineer, and during that time I had a coworker who actually died, sadly, a couple days before his retirement. And that really hit me pretty hard because he had a lot of big plans and he was going to really start living his life at retirement. And to me, I don't get that. Why do you have to wait? And so I did a little reflecting and came to the realization that you really don't. And our company, Elash Investment Group, was founded to invest in multifamily real estate to help people buy back their time and be free to experience more of the magical moments that life has to offer, and help our residents have an enhanced community experience and better amenities and a higher quality of life as well.
Very cool, very cool. You're frozen for some reason in a second. Oh, there we go. That was an interesting look. Well, thank you for sharing that. There's a lot of interesting stuff there. But for one, while we're touching it, I'm a firm believer in the same way that so many people think that you have to wait till you're 59 and a half or 65 to retire. And that's the way you work your way up the corporate ladder. You put your money away in your 401k and then you can retire when you're 65. But I don't believe in that, and at one point I'm sure I did, but it's been a long time since I believed in that because of the power of real estate and, the power of owning your own life and being able to control your own life. And I think, now I don't know how old you are. You look younger than me, but I'm 38, and, I'm not getting any younger. I'm not old, but I feel like now's the time I want to enjoy myself in the next few years where, my son is 11 months old and I want to spend as much time with him as I can, whereas when you're 65, it's not that your life is over, but you've missed, a lot of the experiences and the times that you want to have free have sort of passed. So, I think that's the power of real estate that we both realize, I think.
Yeah, for sure.
Cool. So what, as you've mentioned, the great story that you shared with us, that, you want to help others and That's again the power of real estate. When did you open your eyes to real estate? When was real estate come on your radar? And how did it come on your radar? Because for a lot of people, it doesn't.
So real estate came on my radar for the first time when I was in high school. My dad dabbled in real estate investing. He had a couple condos he rented for a little while, and I didn't really know too much about it, but I also was introduced to Rich Dad Poor Dad at that time. So I read the book. It was fascinating. And in high school, I wasn't really thinking about what I was going to do with my life, really. And so I kind of put it on the back burner. I went to college, studied engineering and nuclear engineering. And at the end of college, can't remember what exactly triggered it, but Rich Dad Poor Dad came back into my life, and I reread it. And it hit me in a different way. And so I read everything I could. I read all of Robert Kiyosaki's books. I've read all of his advisors' books. I tried to learn everything that I could about real estate. And then after about 2 years of reading and just talking to people, we finally started our first LLC to invest in single family homes.
Yeah.
And that was in 2015.
Okay. Yeah, interesting. I always talk about that because so many times, you listen to on podcasts or you read in these forums that people's real estate career starts with Rich Dad Poor Dad, right? But it's I think it's more than that. I always talk about that. You have to be open to that book, and you have to be willing to what the teachings are in that book, because I've shared that book with a few people of my friends and people that I know. Mm-hmm. And it hasn't hit them at all. I say, what did you get out of that book? Oh, yeah, it was a cool story about that guy and his dad and la, 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 and it's like,
yeah,
you have to be in the right place for that book to hit you. Otherwise, it's just, okay,
yep.
You understand the concepts maybe, but it doesn't hit you and it doesn't grab you. Because when I read that book, and I'm sure you're the same for the second time, it kind of grabs you and, it kind of shakes you a little bit because you realize, what am I doing? Or I did anyway. And what am I doing?
Yeah.
It's so obvious, but why didn't anyone explain it to me? And this is amazing. I want to dive in deeper. And I think it's so interesting that you can give two people the same book and they'll read it at the exact same time. And one will go and do real estate investing and be a huge success. And the other one will just keep living their life the same. I think that's fascinating to me.
Yeah.
It's just about being open to that. So then you mentioned you guys started with an LLC. So, there's always, again, that talk of, I see it all the time in forums. Before I start investing, do I open an LLC? Do I get my website up? Do I get my business cards up? And there's varying degrees of opinion on that. So you guys went and built it, started with the LLC. Why was that? And then what came next?
So we started with the LLC because what I had read is that it's best for asset protection to protect yourself and any of your partners from liability that maybe a tenant or a property manager can inflict on you. So the LLC protects your personal assets from anything wrong that happens in the business.
Okay, that makes sense. And it's that extra layer of protection, right? So that
right.
We live in a litigious society.
Yes, we do.
Unfortunately, you want to protect yourself in every way you can. So what was the first property that you guys bought? I think you said it was in 2015. What was the story behind that one?
So the first property we got was actually one of my dad had bought it a few years earlier. And so we brought him on as a partner in this LLC. And what we did was we did a lease option with him. So our LLC essentially rented the property from my dad. And so we took control of it. And I think Robert Kiyosaki talks about this a lot in Rich Dad Poor Dad. It's more about control than ownership. So we took control of the property using a lease option. And then we were able to run the property as a rental as part of a business.
Okay, that's interesting. So what was how did you set up that lease option? Usually a lease option is you agree to buy in 2 or 3 years and there's a down payment up front. Was it that case? And then do you also, sometimes they apply some of the rent to the principal? Was that the case, or how did you guys set it up?
Ours was very simple, and we set it up just, there's no down payment, and it was more of a way to get control. So our company would pay the mortgage, and then after 5 years, we would reevaluate and look to see if we wanted to buy the property from my dad.
Mm-hmm. And did you guys end up buying?
And then
it would have been this year, right? Was it? You see, 2015 was it?
Yeah. Right now we're still leasing it.
Okay.
Actually, to kind of go back, since we're doing multifamily now, and we're actually looking at just dissolving our first company and selling off those properties. Okay.
You say we. So, who is we in this? Is it you and you?
So in the first company, it's my dad, myself, and my brother.
Okay. Okay. So you guys are third owners in this LLC?
Yep.
Okay. And does that property cash flow nicely, or how much were you paying your dad, and then how much were you renting it for?
We're paying him $800 or $850 a month, and it's renting right now for $1,250. We pay a property management company 7% to manage it, and so we net usually about $300 a month on it.
Okay, but that's with zero money out of pocket, really, right? That's essentially a zero money down deal, I guess, right? So not
yeah, in a way.
Yeah. So then what was next after that one?
So after that one, I had moved up to Cleveland for work. This first property was in Columbus. Mm-hmm. I had moved up to Cleveland for work, and so we tried looking at the Cleveland market, and we found a couple of small spots that were really growing. So we found our next property in Lyndhurst, which is a suburb of Cleveland. Pretty good economic. Pretty good economic. Yeah, it's a good area, and it's not suburby, mm-hmm. but it's economic factors are good there.
Okay. And I think most people listening, that they've always heard about people buying in areas that are growing, and that's it's a good area to buy. What did you guys look for in that? How did you guys kind of assess that? Because it's one thing to hear that, okay, we want to buy in a growing area. How were you guys able to mm-hmm. assess that area?
So we used a couple of different tools. We used a website called city-data.com. You can just type in a zip code and it'll tell you like all the demographic and economic information on it. It does, however, use older data, and it uses census data. So when we buy the second property in 2017 or 2016, the census data was 6 years old. Mm-hmm. But you can still kind of verify that with other sites. You can do a Google search on like Lyndhurst crime data 2017 or whatever. And so city data or city-data was one of the main sites we used. And then we also had a property manager that we brought on board before we found this property. And so we used them as a resource to help us understand what the market rents are, what they should be, how much can we rent this property for, stuff like that.
Very cool, yeah. Because even though, like you mentioned, some of the data might be older, things don't move that fast, right? And all you need is a point of reference mm-hmm. to start off with. So if you're analyzing a market or a sub-market, if you're able to see that it's trending in the right direction, the population growth is the job growth is going in the right way, then you can really dive in deeper. But if you see that things aren't, really going in the right direction, well, then maybe you can ignore that area and kind of move on to the next one. I think that, and I like the way that you guys use the property manager, because they're such a great, if you have a good property manager and they kind of know what they're doing, it's such a great resource in understanding.
Yes, it is. Absolutely.
Because they're in there all day, every day. So Can you tell us a little bit about the numbers on that one? I know you liked the area and it was a growing area, but what else you may have liked on that property?
We liked that it was only 97,000, and we were able to rent it for 1250. So that same 7% to the property manager, we net about 200 or so per month. So since it was a growing area, we expected a little bit of appreciation as well. So it was mostly to add a little bit of cash flow to our portfolio and grow our net worth by the appreciation to the asset.
Right. So again, you said that you all three of you bought that property. How do you buy? Did you buy it cash? Did you finance it? And if you finance it, how who goes on the loan? Who does what as well? That's a question I should have asked. Who does what in this partnership?
So the second property, and actually the second property, we did the same way as the first one. So everything we looked at, we were at Bigger Pockets, we were at different meetups and forums. Everything was kind of conflicting about, can you buy a property with an LLC?
Mm-hmm.
If the LLC doesn't have like a huge track record. And so the answer is generally no. And so what people advised us to do was buy the property in your personal name, and then you can transfer title to the LLC. That's not, at least for us, that was not a great idea, because at any point the lender could call the loan if, and then demand full payment of that loan at any time,
Mm-hmm.
because we transferred title out of our personal name. And so what we did, we bought it in our personal name, and then we did another lease option.
Okay.
Similarly to the first one.
So a lease option to the LLC.
Yep.
So that's an interesting structure. I've not heard of that so far. So who had to sign on the loan? Did they get compensated for that, or how did you structure that, or was it just a case of it being part of the deal?
So it was my brother who signed on the loan, and we used funds from the company to help him with the down payment.
Okay.
And so the company essentially paid the down payment, but he was the one signing on the loan. So the title is in his name, and then we lease it from him so we can have control and rent it.
Okay. And then okay. I'm trying to just think of that. So then did you have did you have a maturity date when you needed to buy, or was it just,
we just set a standard 5 years before we reevaluate.
Okay. Very cool. That's such an interesting way to do it.
It was all in the family, so we just tried to push it out.
Yeah. How is that working with your brother and your dad? Is there, working with family can be challenging sometimes. It can be great, but it can be, families will say stuff to each other that maybe friends won't, right? How's that relationship?
Yeah, it's good. My dad and I are still partners on Elash Investment Group, and my brother is still with us on that first company. And it's great working with them, because my brother's a bit more analytical than I am, and he's very risk averse.
Mm-hmm.
Where I am I'd say more than risk tolerant, but not so much as crazy risk taker.
Right. Yeah.
So we kind of balance each other out, and my dad provides a little bit of the expertise, since he has been involved in real estate longer.
Yeah. That seems like a good team, because you need someone yin to your yang, right?
Yeah.
Sometimes when you're by yourself, when you're trying to analyze a deal, whether you're an optimist or a pessimist, whichever way you're inclined, you're going to see that deal from that angle, and you need someone to kind of look over your shoulder and see it the other way. And then you have your dad with many years of expertise and knowledge, I'm sure, that can kind of help guide you the right way, and maybe stop you two from fighting from time to time as well. Maybe he's really in the middle sometimes. Very cool.
Yeah.
Very cool. Well, so then how many properties does that LLC currently have?
So that LLC has 3 properties.
Okay. So
3 single family rentals.
So what was the story on the third one? Where did you buy
the
that?
The third one used to be my primary residence.
Okay.
And when I moved, that one had to get rented or sold before we could close on our new house. And so we decided to have our property manager try and rent it. And it came down to the deadline, but we ended up having a tenant in there by the time we closed on our new house. And so we did the same thing as the R2 properties. Since it was already in my name, we just did another lease option to take control over it.
Yeah. And then how did you guys find the tenant on that one, and how did that one work out?
So the property management company usually does intensive screening and background checks on tenants. And what I think happened here is that got bypassed a little bit because we were kind of in a rush. And so we got a tenant sign up for a 6-month lease. No problem. We can have 6 months to figure out and get a new tenant in there. But when it ended up happening, the tenant stopped paying after 4 months and started trashing the place. And we ultimately had to evict that tenant and spend 6 months and thousands of dollars getting the place back to rent ready.
So I'm sorry that happened. That's unfortunate. It's one of the risks with real estate, right? You never know. But looking back on it, what would you have done differently? Is there anything you would have done differently, and could this have been avoided, do you think?
There's probably a lot I could have done differently. Looking back now, we probably should have just sold the place. But right now, after we got it all turned after that first tenant, we have a good tenant in there now, and they've just renewed for another year. And they're not paying as much as what the market suggests, but they are still in there and they're covering the mortgage. So we're building equity on it and just holding it for now.
Yeah. And that's what real estate is all about, right? I've had my fair share of hiccups and mistakes and things that have gone wrong. At the time, it seems like it's the end of the world. But what I heard someone say one time, and I always say to myself when things go wrong, is that I would rather have these problems and be in real estate and be in the position that I am than not invest in real estate. And it's something that when you come to accept that things are going to go wrong, but you're in real estate, so it's a great thing. As long as you want to be in real estate and real estate investing, things will go wrong, but it's okay because you're in real estate investing and it's the best place for you to be. Well, for me anyway, that's what I believe. So that always helped me because there's been times that I'm like,
yeah, that's cool.
Cool.
Yeah, I've always said, what's the worst that could happen? If it's not that bad, or if it's something you can correct, just go for it.
Yeah.
At least that's what I do.
Yeah, exactly. Because otherwise,
maybe unwisely sometimes, but
well, otherwise you get caught up in analysis paralysis and you don't do anything, right? So,
exactly. Got to start.
Yeah, exactly. So you've got 3 single families in the LLC right now, but your main focus now is on multifamily and syndications and on larger apartment complexes. Mm-hmm. When did a realization come to you that single family wasn't the way that you wanted to go anymore, and that you wanted to scale up into something bigger?
That came in 2018-ish. I was reading a couple articles on bigger pockets because when I first started real estate investing, I secretly wanted to own apartment buildings. I thought that would be really cool. And I thought you always had to level up, spend your time in single families, build up a huge portfolio before you're allowed to invest in multifamily. And I read a couple of articles on bigger pockets, and they kind of opened my eyes and said that's not true, and here's why. And so basically what we found out was you don't need a ton of money to invest in multifamily. You can invest passively or actively. If you invest actively, you need to learn the material and learn it well, and then you can partner with other experienced operators to get your foot in the door and then grow your business and your experience from there.
Yeah, absolutely. Because it's the same thing happened to me. It was the realization that, you living in Vegas and in Tampa before that, you see these large apartment complexes everywhere. But I don't know who I thought owned these, but I never thought for a second that people like you and me are, putting a team together and buying these for a second. But that's exactly what's happening all over the country. People are putting a good team together, learning how to do it, finding people who have experience doing it, partnering up with them, and buying these apartment complexes and making them a better place for tenants to live. And I think that's something that gets missed sometimes, is that, it's very rare that someone's doing a large syndication and their goal is to make the property worse, right? It's always to improve the property.
Yeah.
Yes, it's for a financial gain, of course, but that's why people do it. And, if it means people getting a better place to live and someone gets compensated for it, what's wrong with that? So, I think that's a great story. And, for people to realize that you can be active or passive as well. You can invest in, you can be the guy doing the deals, or you can be someone that's just investing money in the deal and enjoying the ride at the same time.
Exactly.
Well, what was your first venture into multifamily then?
My first venture into multifamily was a passive investment. We invested in a 136 unit apartment complex in the Dallas-Fort Worth area. And that we invested in early 2019, I think it was. And we knew the operator, so they're kind of teaching us stuff at the same time as we're making a little bit of money off this, but they're giving us great updates every quarter at a minimum and showing us how they're progressing with it's a value add opportunity, which means you buy a property that's either operating poorly or rents are lower than the market, and you can go in there and you can optimize the operations, which will bring down your expenses and increase your rents by providing a higher quality of life and a better living space for your tenants, and they will pay a premium for that. And so you go in there and you can increase your NOI by decreasing your expenses with the optimized operations, and then raising your rents, and you can effectively increase the value of the property. And then, so value add property, you would increase the value of the property for a specified hold period. Typically it's 5 years, and then you would sell it or refinance it, pay off the investors, and then they can invest with you again.
Yeah. That's the beauty of commercial and investing in a multifamily, is that if you're invested in 5+ units, the value of that property isn't in the property next door or the property down street. So you're not at the mercy of what other owners are doing. If you're in single family, it's on the comparable sales, right? That's how it's valued.
Exactly.
So what Johnny's doing down the street to his house is going to affect, how much he sells. If he decides that he's in a rush to sell and he sells it for 30,000 below, well, that's going to affect the value of your home. But when you're in the commercial space, if you increase rents, it doesn't matter what's happening all around you. If you're increasing rents, lowering expenses, and increasing that income stream into your property, you're increasing the value, and there's nothing anyone could do about it, right? Of course,
exactly.
Of course, the area can affect it, but if you're able to get those rent bumps and increase the rents and make it a great place to live for people, which again, I don't think is talked about enough, because that's what people do, and make it a better place, because otherwise, it's like the free market, right? It's a free market. If you don't do the right thing, you won't get the money. If you don't improve the property, you won't get the money. So people do the right thing because they want to get the money, and of course, you know, it feels good to make a place better, right? So, but that's the thing. So you're able to force that value of that property. It's called forced appreciation in real estate, and you force that value, and you're in control. And that's one of my favorite things. I'm in complete control of that. If I do everything right, if I analyze the property right, if I buy it right, if I do the right sort of renovations, if I manage that asset or manage the property managers and everything else that goes into that property, I'm going to benefit from that. Whereas, it's not always the case in single family.
Exactly.
Cool. Well, why did you guys decide? So, it seems like you wanted to go active from the start, but why did you decide to go passive to start off with?
We went passive for a couple reasons. The main ones are we looked at a lot of coaching programs out there to kind of mentor us and get us into our first active syndication, and those run from $6,000 to $40,000. And so we thought, why don't we just put $25,000 in a passive investment, learn as a passive investor, and also build our experience with the whole process. And so that was the first thing. And then the second thing is, looking back, it's really good that we've had experience as a passive investor, because when we go to try and raise money, we know what investors are looking for, we know what questions they'll have, and we know what their concerns typically are, because we would have the same concerns as a passive investor.
Yeah, and I think that's another great lesson, because you can pay coaches, and I have one myself. I have a coach myself, and I have a mentor, but they do cost money, right? And a lot of times, if you get a good one and you follow what they say, it's going to be worth it. But at the same time, it's something for you to consider. If you can invest passively in a deal, not only is it not costing you money, you're actually very likely to make money while you're learning. So,
Yep.
right? It's an amazing thing. You get a return on your money, but if you create that relationship with the syndicator as well, hopefully they'll let you in on what they're doing, how they're doing it, because they're getting compensated for that. You're giving them money to buy that property. But you're also, even if that's not the case and they don't do anything, you see their reports, how they report. So you see what they do well, what they don't do well, what you like, what you don't like.
Yep, exactly.
Doing, and you just learn from seeing that, and how they what their investor, how they handle investor relations, right? So it's all those things, and plus you're getting your foot in the door, and you're seeing. So some people as well, people don't even realize, it takes people doing a deal sometimes to realize what side on the fence they want to be in. And if you start, you might start doing a passive deal, and you'd be like, this is the best thing ever. You get to invest in this giant apartment complex. I don't do any of the work. I get a check every month or every quarter, and the returns are really good. And I get tax benefits to go along with it. So it's
exactly. It's awesome.
It is, and I think it's good for people to experience both sides of that, to know which one they want. So you said how many passive deals are you in now?
We're in 2 passive deals, totaling about 550-ish units.
Okay, so some large projects. How did you guys decide on? Have you done both deals with the same syndicator, with the same general partners? Yeah. How did you guys decide on the syndicator that you're going to use, and maybe talk a little bit about what people should consider when they're trying to vet the general partner?
Absolutely. So when you're looking to passively invest, you want to know the syndicator's track record. You want to know who their team is and their team's track record. You want to see kind of what their motivations are, seeing what they have done in the past. You can also look at how well do they know the market that they're offering a deal in. Let's say, for instance, you are a syndicator in Columbus, Ohio, and your property's in Indianapolis. How well do you know Indianapolis? And the person investing should ask that question. And
yeah. It's said all the time, right? You bet on the jockey, not the horse, right? You want to know who the general partners and the syndicators are, because they're the ones running the deal. Yes, you can have a good deal to go along with it. Of course, you're not going to invest in any deal that doesn't make sense. But a good syndicator can turn an average deal great, and a great deal can turn very average if you have a bad syndicator running it. So it's very important.
Right.
and you're giving these people your money, so you've got to you've got to trust them. You've got to understand their risk tolerance. You've got to understand their hold period, how long they're looking to hold the property for. It's usually 5 to 7 years, so you've got to understand your money is going to be tied up for that amount of time. And if you're okay with that, of course, it makes sense. This is not a quick fix and flip type business. It's a longer hold, and get wealthy over that time. But you've got to understand these things. So yeah, I think it's important that people understand.
Absolutely.
How to look for a syndicate. So then you dived in and did your own deal. Tell us a little bit about your own syndication.
Yeah, so after a couple of passive investments, it's actually the same syndicator that we invested passively with. We were working with, he's also living in Columbus, and we got to know each other and become friends. And he brought the deal to us and offered the opportunity to be partners on it, which is like unheard of in this business. And so we definitely took advantage of it immediately. So we partnered with this experienced syndicator to acquire 156 units in Indianapolis. Their property management is in-house, and it's based in Indianapolis, and most of their properties are there. And so that really gave us the confidence to go out and raise money for that deal, because we knew the management team, we knew what they were capable of. We've seen their past work, and it was really exciting to see what they would do with this property.
So it was the property management company that ran it as it was, the in-house management that was currently running the property for the previous owners, or was it a new company?
We brought in new management.
Okay.
So the property management that's there now is our partner's management company.
Okay.
There is a lot.
How did you find that company? How did you decide that they were a good fit?
The company, or?
Yes, sorry, yeah, the in-house company, yeah, management, yeah.
So that came down to trust with our partner. Our partner owned the management company, and we've seen that management company in action over several deals, including some of the ones we invested passively in. And so we were just looking at their body of work and seeing what they were capable of. And it essentially came down to, we trusted the person who owned the company.
Yeah. I think it's important to property management, again, is so important, with these properties. They can make or break deals. And when you're able to see someone's track record and see what they've done, and if they've managed similar properties and had success, it gives you a lot of faith that they can do kind of the same. How did you guys find that deal? Was it strictly through your partner who had that you invested passively with? And how did he find the deal?
I'd like to say one more thing about the management.
Yeah.
Single family management and multifamily management are very different. So you want to make sure, if you're finding a multifamily management company, you make sure they can do multifamily management. So the same management company that's used to 10, 20 units is not going to be equipped to handle a 156 unit acquisition, and especially a value add one. So you want to make sure what you're bringing on the property manager for is what they're used to doing.
Yeah, great point. Because like you said, if they're used to managing single family homes or the odd duplex or whatever, they're not going to be able to handle 100 units, because it's a completely different animal. Yes, it's rents and tenants, but it's a completely different animal. And you also want to get someone that's used to managing, if you have an A-class asset, you want someone that's used to managing an A-class tenants. If you get someone that's used to managing a D, they're going to handle the tenants a lot differently.
Exactly.
So have them used to that kind of processes, and they have systems in place. So yeah, thank you for sharing that, because I think that's important for people to consider when they're vetting management. Yeah. So how did you guys find the deal? So you guys said that you're partnering up with this syndicator experience. How did you guys find the deal?
So the syndicator had a part of their team was cold calling apartment owners and seeing if they wanted to sell their property. And you keep following up, occasionally you'll get something that bites, right? So for this one, we were making cold calls, and for the longest time, this person did not want to hear from them at all. And eventually we called them at the right time, and they're like, well, maybe, what do you want to offer? So then you ask them kind of some basic questions, like what's your income, what are your expenses, general stuff that you can use to calculate a viable offer price, and say, you know, now I can give you a better offer price if I had all your financials. And then that would prompt them to share more of their information with you. And so in this case, the financials that they shared with us were pretty limited. So a lot of it was estimates on this one. And fortunately, our partner's lender was willing to take a chance on it. And so we finally got detailed financials well into the contract and during the due diligence period. And so we had to renegotiate a couple items there due to assumptions that were made that didn't pan out. But it came from a cold call to an owner, and eventually, as long as you follow up and be kind and be understanding and be the person that they want to talk to, you'll eventually get something.
Yeah, it's all about the follow-up, right?
Exactly. At least 5.
That's great. That's great. So what was the purchase price? Where were rents at the time, and where are you hoping to get rents?
The rents were, I don't have the exact figures, but they're about $150 below market. Okay. And the purchase price, if I remember correctly, was six-ish million. And then we budgeted $2 million for capital improvements for deferred maintenance that was there.
Okay. So the raise was what? Yeah, about
2.7 million.
2.7, okay, nearly $3 million. So you know that in itself, to most people, you know, you've got to raise 2.7 million. You know, if you're not around these numbers and you hear that number thrown around, it can be quite scary. But I think, you know, what most people would agree that in this business, if you find a deal, you know, it's a lot easier to find the money, right? So I'm sure that was
right.
That helped you guys a lot. But with you guys just starting out, I know you had the experience of the partners. Did you find challenges in getting people wanting to invest with you?
We had a couple different challenges, and some we weren't expecting. A lot of what we were expecting was, you know, I don't know. This is my first multifamily investment. I'm not familiar with this, that kind of stuff. But one of the biggest ones that we didn't see coming was that people who trusted us didn't want to invest because they didn't know the other guy. They didn't know the experienced syndicator. So even though they were our partner and they had all the experience and the expertise, they wanted us to run the show if they were to invest. And that was really counterintuitive to us, but a good lesson.
Yeah, I would have thought exactly the same way. How do you guys overcome that?
So going forward, we like to keep our investors warm, keep them like in the loop about what we're working on, give them a heads up front that most of our next few deals will be partner deals and will be equal management, and bring on the experienced person to help control all the operations. So
they know up front. So you're saying that the investors that you brought on, they didn't realize, they thought you guys were just solely you guys investing in the deal. It wasn't anyone else running the show. Was that the issue? That
could have been some of it. And then also just not keeping them in the loop. Because this property took us 5 months to close. It was a beast, and some of our investors just forgot what we were doing or invested in other stuff by the time we closed.
how were you guys finding investors for that? Just telling everyone what you were doing? Or?
So we started off with friends and family,
Mhm.
and from there we also tried to leverage some of our network. So I host the Columbus Multifamily Investors Meetup, and we have a lot of people there who are looking to invest actively and also passively. And we were trying to get them kind of interested in passive investing, seeing what they were really looking for, what if this deal was something they would be apt to invest in.
Mm-hmm. Yeah, holding a meetup is such a powerful thing, right? I'm sure you can attest to that. That just being out there and being seen as a thought leader, right, is someone that is investing in real estate and that is hosting a meetup. You know, you're just going to gain a bigger network from that. So I think that's great.
Exactly. Yeah.
Yeah. Fantastic. So you said it took 5 months to close on that. What was
yeah, it did. So it took quite a while for the due diligence, and after our inspection, we had to go back and negotiate with the seller because what the seller was telling us differed from what we found during our inspections. And so there was a lot of negotiations back and forth, and ultimately the seller came down in price, and then it wasn't quite enough to where it was the best deal that we thought it was. And so we went back to the lender and renegotiated some of the terms on the loan agreement. And so we were able to get a lower rate, and as well as a lower purchase price from the seller. And ultimately that was able to get our deal where we were comfortable offering it to investors. And then the rest of it was raising money.
How does that conversation go with the lender? Because, you know, all of us would want a better rate, a better terms, right? But how does that conversation go, and how were you guys able to negotiate that?
I wasn't the one who had that conversation, but it boils down to the relationship you have with your lender. Multifamily is a team sport, and every relationship is important. And so the relationship our partner had with the lender, they had done several deals before. The lender trusted us, and we're confident that they would get a good return from this investment, even if they did lower the rate a little bit.
Yeah, absolutely. That's such a great point that I always try to hammer home, is the importance of team, right? And if you have a lender as part of your team that, you know, believes in you, knows what you can achieve, you know, it's lending is always about risk, right? If the greater you are risk to those lenders, the higher they want the interest rates, you know, the less favorable the terms. But if they know that you are capable of pulling off a deal like that, and you have the team together, and they believe in you, you know, it's easier for them to lower that rate, especially knowing what you guys probably told them about the inspections and whatnot. So they're going to be a lot more willing to work.
Yep, exactly.
How do you structure the returns to the investors? Was there a pref? Was it a waterfall? How did you guys split the equity?
There was no preferred return, but we did give 85% of the equity to the investors and only 15% to the GP. So that was sold pretty well, especially with the high returns we were projecting. I think we were projecting 9% cash on cash and 14 or 15% IRR, or annual return.
Yeah, those are great returns. So I'm sure it wasn't too hard to sell, right? It wasn't too hard to sell, especially with the team that you guys have put together. Cool. Sounds like a great deal. I'll be excited to hear. You guys closed on it, you said, in October, November?
Yep, October 2019.
Okay. And collections are still doing well despite COVID so far?
Yep, collections are still up, fortunately.
Great. Well, long may that continue. Thank you. Thanks for sharing that story. As this show is called Wrestling with Real Estate, I've got to ask some wrestling themed questions. So they're real estate questions, but they're disguised as wrestling questions. So the first one is, what would your wrestling name be?
So this has nothing to do with real estate, but I'm very avid lover of the ocean, and I'm in awe of the power of it. So my wrestling name would be Poseidon.
Poseidon. Okay, I like that a lot. I like that a lot. So are you big into sailing and or boating or just being by the sea?
Everything.
Okay.
I love being on boats. I love being in the water. I just started trying to surf a couple years ago. Still learning, but it's awesome.
Oh, very cool, very cool. So Poseidon's jumping in the ring. What would be his special move in real estate? So every wrestler has a special move. What would yours be in real estate?
I would say persistence or perseverance. Real estate is a team sport, and it's a really hard thing to do. So I'm not one to give up easily. If I focus and set my mind to something, I usually keep working at it until I reach it, or I reevaluate and then change my trajectory and keep going in that direction. So I'm perseverant and definitely going to keep going no matter how slow I go.
Yeah, and that's the main thing, right? It's not always about speed and getting somewhere. You know, you're going to hit some speed bumps along the way, but you've just got to keep going. And if you keep going in the right direction and you have a plan and a goal in mind, you're eventually going to get there, right? It's the turtle and the hare, right? It's, you know, you're going to get there and going and you don't stop. That's cool.
As long as it's in the right direction.
Yeah, exactly. Exactly, yeah. What's been the biggest body slam you've taken in real estate?
It would probably be the one single family we had where we put in a bad tenant and had a huge deal evicting them and trying to get the property rehabbed back to its normal state and ready to rent. And that's probably been the hardest thing. At least that took the most cash for sure.
Okay. Was there a moment you were Poseidon standing on the top rope, getting ready to jump in the ring, the real estate ring, but you were scared? What was it, and how did you overcome it?
So I am scared of doing a lot of things in real estate. But I think I mentioned this earlier. I go back to the question, what's the worst that could happen? And if it won't kill me, or if it's not going to financially ruin me, or if it's something I can correct, then I'll go ahead and try it or go forward with it.
Yeah, it's just going forward, right? Taking action. That's kind of, you know, facing your fears is always the best way I found anyway to kind of overcome that, right? if you're scared of heights, jump out, you know, do a parachute jump, right?
Right.
hopefully that cures it. Well, cool. Well, thank you for sharing those answers, and thank you for sharing your experience and your journey. I'm excited to see what comes next, because I don't think you're finished, right? It seems like this is only the beginning for you, and you know.
Yeah, we're just getting started.
Exactly. So for anyone who wants to get a hold of you, find out more about you, maybe find out about your meetup, find out about you know, your next investments, how can they get a hold of you and find out more?
You can go to find out more about me. You can go to elashinvestmentgroup.com or cashflowinvestor.co, just the CO, no M on the end there. So Cashflow Investor is our investing platform. And if you want to learn more about what investments we offer, you can go there, sign up, and you can view our previous investments, or any sample investments that you might be interested in. Or you can just reach out to us. There's phone numbers on the sites. For the meetup, we have a Facebook group, the Columbus Multifamily Investors Meetup. And we also have a meetup page on meetup.com, same name, Columbus Multifamily Investors Meetup. We'd love to have you. Very cool.
I was just, because of the time difference, I got there as the last one was finishing. I think you sent me the recording.
Yeah.
I was literally caught the last words the presenter said, but I have the recording, so I'll watch that back. So Thank you for being on the show today. Thank you for sharing all your experiences and everything you've done. I think there was some lessons in there and some great bits of knowledge. So thank you, Matt, for wrestling with real estate.
Thanks, Barry. It's great to be here. Thanks for having me.
Cool, cool.